Money is a concept that governs the global economy, influencing every facet of our lives in ways both direct and indirect. It has been around for centuries, evolving from simple bartering systems to complex digital currencies, yet its core purpose remains the same: serving as a medium of exchange, a store of value, a unit of account, and a standard of deferred payment. Despite its pervasive presence, there exists an untold truth about money: its power, influence, and the profound effect it has on individuals, societies, and entire nations. To understand the untold truth about money, we must first trace its origins and how it became such a fundamental aspect of human civilization. The history of money can be traced back to ancient times, when people exchanged goods and services in the form of bartering. In these early systems, individuals traded one thing for another based on mutual need or desire. However, bartering had its limitations. It was inefficient, especially when the two parties involved did not share coinciding needs. This led to the creation of commodity money, such as livestock, grain, or precious metals, which had inherent value and could be easily exchanged. Gold and silver became the dominant forms of commodity money due to their durability, portability, and rarity. As societies grew more complex and trading expanded, it became clear that a more standardized system was needed. Paper money emerged as a solution, initially backed by tangible commodities like gold or silver. These notes represented a promise to exchange them for a specific amount of precious metal, which gave them value. This system of commodity-backed currency, however, began to change over time. In the 20th century, with the rise of global markets and the abandonment of the gold standard, money began to be based on fiat currency. Fiat money has no intrinsic value. Its worth is derived from the trust and confidence that people have in the government or institution that issues it. This transition to fiat currency is a critical point in understanding the untold truth about money. Unlike gold or silver, which have inherent value due to their scarcity and utility, fiat money has no intrinsic worth. Its value is entirely dependent on trust. People must believe that the money they receive in exchange for goods or services will hold value in the future. This trust is maintained by the issuing government or institution, which can regulate the supply of money through various monetary policies. Unsustainable. If the government issues too much money, it can lead to inflation, eroding the value of the currency. Conversely, if too little money is issued, it can lead to deflation, stifling economic growth. The complexity of money deepens when we consider its role as a store of value. The idea behind this function is that money allows individuals to save their wealth and use it at a later time. However, this concept is not always reliable. Inflation, as mentioned earlier, can erode the purchasing power of money, meaning that the value of money today may not be the same in the future. Historically, we've seen periods of hyperinflation where the value of money collapses almost overnight. One of the most infamous examples occurred in Germany in the 1920s during the Weimar Republic. The government printed excessive amounts of money to pay for war reparations, which led to a dramatic collapse in the value of the German mark. People had to carry wheelbarrows of paper money just to buy basic goods, and the currency became practically worthless. This example demonstrates the precarious nature of money's role as a store of value. Another critical aspect of money is its function as a unit of account. In simple terms, money serves as a measure of value, allowing people to compare the worth of different goods and services. This function is integral to the functioning of markets. Without a common unit of account, it would be difficult to determine the relative value of different products, making trade much more complex and inefficient. However, this role is not as straightforward as it may seem. For one, the value of money can fluctuate due to various factors, such as inflation, interest rates, and geopolitical events. This means that the unit of account function of money is not always stable, and the value of money can shift dramatically over time. The final function of money is its role in deferred payments. Money allows individuals to enter into contracts that involve future payments, such as loans or mortgages. This function of money is deeply intertwined with the concept of time. In modern economies, we borrow and lend money based on the expectation that the value of money will remain relatively stable over time. This is why central banks and financial institutions place such a high priority on maintaining low inflation rates. If inflation is too high, the value of money can decline quickly, making it difficult to honor long-term financial obligations. However, the concept of money as a means of deferring payments also creates opportunities for exploitation. When governments or financial institutions issue excessive amounts of money, they can manipulate the value of money to their advantage, often at the expense of ordinary citizens. One of the more insidious aspects of money that is often overlooked is its role in perpetuating inequality. In modern economies, the distribution of money is far from equitable. A small percentage of the population controls the majority of the wealth, while the rest of society struggles to make ends meet. This wealth inequality is not a natural consequence of individual effort or talent, but is instead a product of systemic factors. For instance, the creation of money is controlled by central banks and governments, which have the power to influence the flow of money in the economy. These institutions can decide where money is directed, whether to the wealthy, elite, large corporations, or specific sectors of the economy, while leaving ordinary individuals with less access to financial resources. Furthermore, the global financial system is designed in a way that favors wealthy nations and corporations. The international monetary system is built on the dominance of certain currencies, such as the US dollar, which gives the United States significant power in global trade and finance. This creates a situation where developing countries are often at the mercy of international financial institutions like the International Monetary Fund, IMF, and the World Bank, which impose economic policies that benefit the global elite. These policies, such as austerity measures and structural adjustments, often result in cuts to social programs and public services, exacerbating poverty and inequality in these countries. The concept of money also plays a significant role in shaping human behavior. People often think of money as a means to an end, a way to achieve happiness, security, or success. However, this mindset can lead to unhealthy attitudes toward money. The relentless pursuit of wealth can create stress, anxiety, and a sense of emptiness. Studies have shown that after reaching a certain income level, additional money does not necessarily lead to greater happiness. In fact, the obsession with acquiring more wealth can lead to a cycle of dissatisfaction, where individuals constantly strive for more without ever feeling content with what they have. This psychological aspect of money is often overlooked in discussions about its economic and political roles. Moreover, money has the power to shape societal values and priorities. In a capitalist society, success is often measured by how much money one can accumulate. This creates a culture where wealth is seen as a symbol of personal achievement and people are judged by their financial status. In such a society, those without money are often marginalized, seen as failures or undeserving of success. This can create a divide between the wealthy and the poor, perpetuating a system where money dictates social status and opportunity. In addition, money is a tool of control. Governments, corporations, and other institutions use money as a means to influence behavior, whether through taxation, subsidies, or incentives. For instance, tax policies can be used to encourage certain behaviors, such as investing in renewable energy or buying health insurance. Similarly, companies use money to shape consumer preferences, often through advertising and marketing campaigns designed to create demand for products that people may not need but are persuaded to buy. Money, in this sense, becomes a tool for manipulation, with those who control it exerting influence over the choices and behaviors of others. The rise of digital currencies and financial technologies further complicates the narrative around money. In recent years, the advent of cryptocurrencies like Bitcoin and Ethereum has challenged traditional notions of money and finance. These digital currencies operate independently of central banks, relying on decentralized networks to facilitate transactions. Cryptocurrencies promise greater transparency, lower transaction costs, and increased financial inclusion for people in underbanked regions. However, they also introduce new risks and uncertainties. The volatility of cryptocurrencies, combined with the potential for regulatory crackdowns, creates an unstable environment for those who invest in them. Moreover, the anonymous nature of cryptocurrency transactions raises concerns about their use in illicit activities, such as money laundering or funding terrorism. In conclusion, the untold truth about money is that it is much more than just a means of exchange. It is a force that shapes the economy, influences human behavior, and dictates the power structures within society. Money is not just a neutral tool. It is deeply embedded in the social, political, and opportunity for some, while perpetuating inequality and hardship for others. The power of money lies not only in its ability to facilitate trade, but also in its ability to shape the way we think, behave, and relate to one another. Understanding the complex nature of money is crucial if we are to navigate its impact on our lives and the world around us.